You may have heard that investing in stocks can be a great way to create a wealth over time, and it's certainly true. But do you really know how the stock market works? Or what makes stock market different from stock exchange or stock index? If you are interested as one of my subscribers in the basics of stock market, stock index and stock exchange, here's a video about it. Just make sure to like the video and subscribe to my channel. What's up guys, this is Taxpert. On this channel I share with my experience on investing and personal finance, so we together can invest more properly and get more returns. You can check out my other videos about investing for beginners and top picked stocks in the description. You may also want to check out a 100% commission-free eToro investing platform. Sign up link in the description. So how did the stock market works? Stocks, also known as equities or equity securities, represent ownership interests in companies who choose to have their shares available to public investors. Stock markets facilitate the sale and purchase of these stocks between the individual investors, institutional investors, and companies. There are two components of the stock market: the primary market and the secondary market. The primary market, when the stocks first become publicly traded through a process known as the initial public offering (IPO). This involves a company selling shares or pieces of itself to investors in order to raise capital. This initial sale comprises the primary market. After the IPO takes place, virtually all subsequent stock trades take place between investors. That is, the company is not involved. Stock exchanges such as the New York Stock Exchange or Nasdaq facilitate the buying and selling between investors. The vast majority of stock trades take place in secondary market between investors. That means that, for example, if you want to buy shares of Tesla and hit the buy button through your broker's website, you are buying shares that another investor decided to sell, not from Tesla itself. How are prices determined on a stock market? Stock prices on exchanges are governed by demand and supply. Plain and simple. At any given time, there's a maximum price someone else is willing to pay for a certain stock, and the minimum price someone else is willing to sell shares of the stock for. Think of stock prices as an auction, with some investors bidding for the stock that other investors are willing to sell. If there is a lot of demand for a stock, investors will buy shares quicker than sellers want to get rid of them, and the price will move higher. On the other hand, if more investors are selling a stock than buying, the market price will drop. Taking it a step further, it's important to consider how it's possible always to buy or sell a stock you own, and that's where market makers come in. Market makers ensure there are always buyers and sellers. In order to ensure that there is always a liquid marketplace for stocks on exchange, individuals, known as market makers, act as intermediaries between buyers and sellers. Market makers buy and hold shares and continually list buy or sell quotations for shares. The highest offer to buy shares listed from a market maker at any given time is known as the bid, and the lowest offered selling price is known as the ask. The difference between the two is called spread. The main reason for using the market maker system as opposed to simply letting investors buy and sell shares directly to one another is to ensure that there is always a buyer to match with every seller and vice versa. If you want to sell a stock, you don't need to wait until a buyer wants your exact number of shares. A market maker will buy them right away. What happens when you buy a stock? Investors must carry out the transactions of buying or selling a stock through a broker, which is simply an entity which is licensed to trade in a stock exchange. A broker may be an actual person who you tell to what to buy and sell, or more commonly, This can be an online broker that processes the entire transaction electronically. When you buy a stock, here's the simple version of how it works. You tell your broker what stock you want to buy and how many shares. Your broker relays your order to the stock exchange, and the market maker sells you shares at the market price. The shares are then delivered to your account. How does a stock index track the stock market? You probably heard phrases such as "market is up" or that a stock beat the market. Often, when discussing the stock market, people generalize the market to a stock index. Stock indexes such as the S&P 500 or Dow Jones Industrial Average are a representation of the performance of large group of stocks and are often used as a benchmark to compare the performance of an individual stock or entire portfolio. For example, the S&P 500 index tracks the performance of the 500 largest companies in the United States. Indexes are a convenient way to discuss an approximation of what's happening in the stock market, but they do not fully represent the entire market. And summarizing this video, there are three terms with similar and often misunderstood meanings. The stock market. This refers to the process of investors buying or selling a stock with one another. Second is stock exchange. This is the actual intermediary which connects buyers and sellers, such as the New York Stock Exchange or NYSE. And the third is stock index. This is a numerical representation of a group of stocks that is used to track their collective performance. I hope this educational video was useful for you. If you want to watch more of these videos, the links are in the description or right here. I'll be happy to read your investing journey in the comments, and don't forget to hit the like button and subscribe to my channel. See you next time.